This is Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour.
But overall, yes, for a few reasons. Fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Asian stocks set for gains as the Fed cuts a quarter point and gives a risk-friendly economic outlook. Swaps traders still pricing in 2 more reductions over the next year, while the Fed itself signals just 1. Today's cut not enough for President Trump, who says it could have been doubled, calling Chair Jay Powell a stiff. Also ahead, Oracle plunges after the bell as disappointing cloud revenue suggests a delayed payoff from its AI bookings. And the CEO of Mizuho Financial Group joins us live to discuss their business strategy and outlook for the BOJ and the Japanese economy. Now, we saw the Fed delivering its third straight rate cut, 25 basis points as expected. It kept its projections for another rate reduction next year. Markets still betting on 2. In its statement, it reverted to language last used to signal a pause. And this was interesting to me in that it'll also begin buying $40 billion worth of T-bills per month. And this starts Friday. So this is sooner and more than most market participants anticipated. We saw stocks, bonds rising, particularly on the short end. The dollar saw its steepest move down by the most since mid-September. To the dissent, we saw how the cut was approved 9-3. And among the dissenters, we saw 2 hawkish ones, 1 dovish ones. And we also heard from Chair Powell addressing the dissent. Take a listen.
It's a close call. We have to make decisions. And we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do 2 things at once.
So the question really is what happens in 2026, right? But so far, given that we have seen the dollar fall alongside Treasury yields, Asian currencies will be at play. Take a look at how the Japanese yen is trading at that 156 level against the U.S. dollar. We saw strength in the overnight session. We're following JGBs very closely as well, given that, of course, we were at multi-year highs. But will we see some relief coming from the action overnight? Nikkei futures not doing much. We could see some of that bullish sentiment that we saw after the Fed rate cut dissipate a little bit, given that in extended trading, we actually had Oracle falling on concerns about AI spending. But the ASX 200 in the staggered open right now gaining 0.6%. For more on the outlook for the Fed and the markets, let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. Also joining us is Senior Markets Editor John Authers. John, let me start with you, because some people have classified the Fed's rate cut as moderately hawkish. How would you see it?
It's moderately hawkish, but the important point for why the markets have behaved as they have done today is that it's far less hawkish than it might have been, and so that counts as a dovish surprise in the sort of bird watching language we use on these occasions. I think the other key point is that the balance sheet, the fact that they're not going to call it quantitative easing, but the signal that has been received by the markets, even if it wasn't the one that was meant to be sent from the fact that they're resuming bond purchases, is that the world is going to be made very safe again for taking risk, that the Fed is going to be feather bedding the bond market over the next few months.
Garth, let's bring you in here. Would you agree with that view? Very safe for markets in a way. And is this the start of a sort of mini QE?
Well, it's not so much a mini QE as an assurance that the Fed, is going to act as a backstop in general, providing liquidity, at the short end. It reminds me of when they stepped in to provide liquidity when we had the banking crisis almost 2 years ago. So they're making it clear to everyone they will act to smooth things out. In a lot of ways, I thought the key comment from Powell was he was saying that they're seeing a better growth outlook in general, but then, and signaling also with the comment about, they've only got one tool, so they can only focus on one thing, and they're worried about the labor market. So they see a stronger economy in 2026, and implicitly they're sitting there ready to pull the trigger on fresh rate cuts if the economy falters at all. And inflation concerns that had exercised them for much of the last 6 months or so, those are very much on the back burner now. So that does add up to a more dovish approach than people had expected, and therefore the sort of thing that will encourage risk-taking.
And yet, Garfield, are markets getting a little bit way ahead of themselves, especially from the Fed, given that they're right now pricing in, 2 more rate cuts in 2026, not necessarily what the dot plot is telling us?
Yeah, I mean, the markets might also be looking at the idea that President Trump is going to be naming a chairman to take over from Jerome Powell. Whether or not the president manages to rearrange some of the staffing at the Fed, he will be putting a lot of pressure on the FOMC, and that's going to be hard to resist. Again, unless inflation really reaccelerates, you're going to have a bias towards that second cut. So markets are kind of saying, we expect a second cut, and if we don't get it, it's probably going to be because growth is good enough that it's not going to matter, that it's not going to be needed.
John, given the dissent that we've been seeing, talk to us about this idea that debate, discourse, given the conflicting inflation and employment pictures, is that actually maybe a good thing for the Federal Reserve?
I think it quite possibly would be. It's been an unusual central bank in global terms in being led as decisively as it has been by its chair for most of the last few decades. And you could argue that there's some groupthink going on, that it would be better if there was a broader spread of views. I do think part of the response to this, and part of the fear that this really is suggesting some kind of a treasury takeover, is that it was a whisper number, but people were talking about 4 or 5 hawkish dissents by Fed governors just wanting to demonstrate to the administration they weren't there to be pushed around, that they had their independent source of power and they were going to do what they saw fit, not what the government told them. It's quite interesting how few of them chose to do that, and that feeds into the fear that this isn't going to be the Fed independence really is in play.
Garth, before we let you guys go, how are we setting up for the Asian market opens? It looks like Oracle may be souring a little bit of the bullish sentiment that we had overnight.
Yeah, Oracle is reviving the concerns that the extremes in AI spending are not going to be justified ultimately by the returns they generate for many of the companies involved. It's turning into something of a potential zero-sum game where 1 or 2 of these big spenders are going to do very well, and then some of the others are not going to do very well. So that's a concern. But I think Asia should have a mostly positive day because the clearest move across markets overnight was a weaker US dollar. And that's been a concern around a range of Asian markets. It's certainly a concern in Japan, where the yen has been flirting with further declines. And the won, for example, the won's weakness had the BOK and the government so exercised they were talking about how can we fix this yesterday. So a weaker US dollar is something that should cast a bit of a rosy glow on Asian markets this morning.
Gentlemen, thank you to you both. Great to chat. Garfield Reynolds, who leads our Markets Live Asia coverage, and our senior editor for Markets, John Authors. Now, much more reaction to the Fed coming up when we speak with Robertson Stephens and UBS Global Wealth Management. But first, our conversation with Mizuho Financial Group CEO Masahiro Kihara about the outlook for the BOJ, Japan's economy, and their business. This is Bloomberg.
In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate.
And take a look at how we're setting up for the Japanese market opens, because we had some strength for the Japanese yen in the overnight session. Of course, the dollar down alongside Treasury yields. And you can see Nikkei futures right now not doing much. And what we'll be watching is a JGB space. Of course, we were at multi-year highs already. Will we see some relief in the bond space? But take a look at how banks have been trading so far, because we have seen that outperformance in recent weeks, given the expectations of a Bank of Japan rate hike. And really a difference with what's been happening with the semiconductor trade, so exciting at one point but faltering in the last few weeks. In fact, we have seen now the biggest Japanese banks raise their earnings target for the year to fresh record highs. Our next guest runs Japan's third largest lender. They aim to become Asia's top investment bank by bolstering equity underwriting and M&A advisory. Joining us now is Masahiro Kihara, President and Group CEO at Mizuho Financial Group. Welcome to the Tokyo studio.
Thank you very much for having me. Thank you very much for having me.
And what a day, because we're coming off the Fed's consecutive third-rate cut. Do you have a reaction to what they did?
No, I mean, we have seen a little bit of slowdown in U.S. economy, right? Unemployment was moving up a little bit. We have seen delinquency rates for auto loans or credit card move up a little bit. So I think this is a relief. Yeah.
And you have a big business in the U.S., especially investment banking. Will this have implications for you?
Well, I think, it will have a positive effect on our business. The momentum will continue probably, and that's good for us. Yeah.
When it comes to the economic outlook for the U.S., do you expect the Fed to do more, given what you talk about those challenges?
Well, I think that's what we expect. I'm not maybe 2 or 3. Yeah.
In 2026.
Yeah.
You are already seeing the slowdown in the U.S. economy.
Well, if I talk with my people, what's happening in the real world, it looks like a little bit of slowdown is happening. Yeah. Although it's not still on the figures yet, but I think that's the reality. Yeah.
But when it comes to those rate cuts, as you mentioned, it's still very positive for your business.
Oh, of course, it's very positive for us.
Where is growth for you in America?
Well, so we have been building out our investment banking business to a full scale. 2 years ago, we bought M&A boutique from Greenhill. We finished the integration, and that by using our Mizuho platform and Greenhill platform, we are now able to pursue large scale M&A deals, get the full value chain starting from M&A. For example. Recently, we did a big deal for Skechers, where Skechers was acquired by Strategics Capital. In the old days, we never thought about that. Right now, we can do that kind of deals. Also, cross-border deals, Japan, U.S., that's expanding our platform too. So U.S. is becoming a catalyst for our growth, actually.
Are you seeing a lot of competition from other domestic rivals?
Not really in this U.S. investment banking. I think I think our strategy is to get all the capabilities that we want inside our bank. Actually, right? Mitsubishi, SMBC is a little bit different. The strategy is so not seeing a lot, bro, and rather seeing more competitions from European peers or. We're not going to be the 5 peers like the U.S. banks, but rather competition is from the European banks probably. And from a global perspective, our CIB league table, we were 13th last year. This year we ratchet up to 11th actually.
Yeah, you continue advancing in that market. And you mentioned the U.S.-Japan cross-border deals as well. There's a lot of activity here.
Yes, there is.
Give us some of your outlook for 2026.
So I guess, I think everything starting from the corporate governance reform that has been executed by the Tokyo Stock Exchange, and that is still continuing, I think. And people, and the mindset of the CEOs has changed that they need to improve their returns, ROEs, they need to invest. And we have been very, very strong in the large cap sector. And we have been able to capture corporate actions based on such momentum change. Also, what's interesting is that momentum change is spreading out into the mid caps too. Let's say 50 billion to 100 billion market cap. And we added on CIB capability in the mid cap sector. And what happened is that in 3 years, the revenue, the CAGR was somewhere around 60%. So I think the economy is trying to revive. The corporates are starting to make sure that they want to, starting to improve their return. And then we have a new prime minister who is eager to, grow the economy. So I think overall, Japan will be very, very interesting.
Prime Minister Takaichi had to talk about the concerns around rising JGB yields.
Yeah.
Is that a concern for you, the pressure that we're seeing in the bond space right now?
Well, I guess, BOJ will raise rates this month probably, right? And then
you're expecting the rate, hike next week. Yeah.
And then as long as the real wage, the wage increase continues next year, BOJ will have room to increase rates again next year. The question is, the government has to set out to the market that they will keep discipline on fiscal policy, although they can be proactive to a certain extent. If they do that, constantly do that, I think there won't be a crazy shock. The rates can go up, JGB 10-year can go up beyond 2%, but I think it will remain in the lower end.
Remember what happened last summer when we had the yen crazy unwind there? Do you think this is better choreographed?
Yeah, I think so. So if we talk about yen, we had Fed rate cut. Still, the yen rate is 155.
I know, it's not budging.
Yeah, so even if BOJ raised rates, I don't think that will change a lot. Based on the fact that, still the real interest rate is negative in Japan, if you consider about the inflation. And there's some structural things like, increasing digital service payment, etc. So I think, we see the rate cuts, increase, narrowing of the gap. There can be, appreciation in yen a little bit, but I think it's going to be somewhere around 145 to 150.
It's going to be capped at those levels.
Yeah, it's not going to be huge. You won't see huge, yen appreciation.
Does that have implications for business activity within Japan?
Well, I guess that for if you think about mid cap, small business, small cap, that definitely hurts actually.
Yeah.
But if it is for large or it doesn't matter a lot.
But you're also targeting the smaller firms, right? We have seen a lot of private market activity in Japan too.
Sure.
Are they competitors so far?
I think they are very friendly collaborators with us.
Okay.
Yeah. So I think they are game changers for the market too, actually. So if the large caps want to change their business model, the private equities firms can step in. We definitely collaborate with them. We don't see a lot of private credit here.
As of yet, but I see that targeting right now.
I know. But I think they are also a friendly collaborator with us. So if you have a large M&A deal, I would say that the 3 mega banks and private credits work together to get the deal done. So I think, it's not like a competitor, I think. Yeah.
Still the Japanese market is so restricted, right? You have demographics issues, and you're trying to expand overseas.
Yeah.
Let's talk a little bit about India, because I didn't get an update on, say, that majority stake from Aventus Capital. What's happening there?
Well, we are constantly discussing about how to finish it, actually. That's
Yeah.
it. I think, I hope that we will get a good news.
So the talks are still ongoing?
Oh, yeah.
What's the issue?
I can't see that.
Valuation?
No, that's
exit
finished.
strategy?
That's finished.
That's finished?
That's finished.
So when can we expect something?
Maybe early next year.
Oh, okay.
Okay.
Oh, you join us next time to talk about that?
If you invite me.
Of course I will. China, you're
Yeah.
citing brokerages, but that's been a challenging market even for your competitors.
Yeah, I think so. We want to, commit to the growth of China economy, actually, and we definitely have a corporate banking platform. But I think we want to further expand our business there. We need a capital markets capability there. We know that it is a challenge, but I think it's worth doing that challenge for us. Yeah.
What's the strategy different to what your competitors are doing?
Well, I'm not quite sure about what my competitors are doing. I think rather we in China we will start with the capital markets actually. Traditionally we have been very good in the capital markets. We've been expanding our equity capital markets business, but I think in a new market we should start with the capital markets. So we won't really fully go into equity capital markets.
How big of a concern are the geopolitical tensions, whether it's trade and tariffs, whether it's what's happening between China and Japan?
There's always tensions, I think, but I think so. You have to be self-dependent. You have to leverage on your strengths, what you have. But having said that, also, you can't be self-dependent entirely, right? You have to collaborate with countries, nations, people around the globe. And I think whatever tension there is, our mission as a global financial institution, having a network all over the world and having clients all over the world, our mission is to connect the clients and get collaboration between the clients. Okay. And we want to be a bridge for that. And that will expand our business, actually.
Masahiro Kihara, really good to have you with us.
Thank you very much.
And you promised us to join us again for that India deal. You guys heard it. President and Group CEO of Mizuho Financial Group will join us again at the beginning of next year. More ahead. This is Bloomberg.
In reaction to the Fed, we are seeing the dollar dipping and moving by its most since the middle of September. This could set up some reprieve for Asia currencies, particularly the likes of the Indian rupee and the Korean won that have been coming under pressure of late. Something to watch for the session. This is Bloomberg.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. Available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months. So I don't think that a rate hike is anybody's base case at this point.
Let's discuss the Fed's latest rate cut and the state of the U.S. economy and bring in Jeanette Garretty, chief economist at Robertson Stephens. Jeanette, always good to have you with us. Just first of all, react to what the Fed did.
Not unexpected that they would go with a rate cut. Little bit unexpected some of the current dissension, and we can talk about that a little bit later. And also the what is being called the RMP, the Reserve Management purchases. That wasn't unexpected either. So it was good to see all of those expected things come out. However, there's a lot in the summary of economic projections that was less certain and some of it a bit surprising, largely a message of growth.
Yeah, we just heard from the Mizuho CEO Kihara-san talking about 2 to 3 rate cuts from the Fed next year. What are your expectations given what we're seeing from the dot plot as well?
I think the dot plot sends a different message. Dot plots can change. One of the subtexts, although it wasn't really emphasized during the press conference, was the remaining uncertainty about, especially the labor market, but just in general about what is going on in the economy. So the resolution of some of that uncertainty could change those dot plots very easily. But the Fed continues to say 1 rate cut. I'm not going to argue with them. Let me put this perspective on it. 3 rate cuts would actually concern me, because that would imply that the economy is weaker than we presently see, considerably weaker. It can happen, but I think it would say some things about overall economic growth that would not be a happy situation.
Jeanette, you said earlier that the RMP was a bit of a surprise. Why? And is this more about financial conditions, or do you see implications for the economy?
Oh, actually, no, it wasn't a surprise. It wasn't 100% certain that they would announce it in this meeting, but there had been an expectation that they would take this action. And I have seen some commentary that is this a return to quantitative easing? Is this, in fact, a way of getting more into the economy? 1 small rate cut, but we're doing this as well. But I don't really see it that way at all. I think this is very much just about classic open market purchase actions designed to, improve liquidity in key markets. So I don't think much should be made about the fact that it looks to some people like quantitative easing. It's not.
Okay, talk to us about what you're seeing among the dissenters. This is a Fed that is, very split, and it's in public view. What is that going to look like in the first half of next year, you think?
So it's quite interesting. The way I would frame this is you have a lot of very good students of the economy that sit on that committee. And I think a significant number are saying if the U.S. economy is growing as strongly as we see it right now, and to put a fine point on it, if Scott Bessent is correct in saying that the U.S. economy is growing at 3%, then is there really a purpose or a need to cut interest rates aggressively, especially if you think that growth may not be the entire explanation for why employment growth is slowing? There was an interesting positioning by Chairman Powell right up front in the press conference, where he said primarily he felt that the employment weakness was due to the lack of growth in the labor force. And then he acknowledged that there also had been some softening of employment demand. But he first went to the point about the labor force. The Fed cannot fix the labor force issue with interest rates.
And yet we are expecting a new Fed chair to come in next year. And the Fed independence risk, how pronounced will it be, and how will that play into the U.S. economy and just the Treasury space? Because we continue to see the immense pressure. Yes, Treasury strengthened in the overnight session, but we're also, again, contending with more supply even this week.
Yes. So it's going to be a risk in this sense. It is going to be a topic of conversation all the way through, even after any announcement is made as to who is going to be the new chair. It's going to be perceived as a risk by the markets. How real a risk? The members of the committee are strong, independent members themselves. Honestly, I think you saw some of this in Kevin Hassett's comments this week. He's the presumed front runner for the job, but that could change. But he went out there and said, look, I value the Fed independence. I'm going to respect the Fed independence. Everybody knows this is very important to global financial markets that be maintained. So I think they will actually be very, very careful about unreasoned or poorly reasoned monetary policy actions. As long as the economy is growing and the equity markets are validating that, which they did today. I think if you look at what the equity markets did today, they heard that message of economic growth loud and clear that Chairman Powell was talking about. And even more to the point that he was talking about, or the committee was showing that they believed economic growth would be stronger in 2026 than they had originally thought, and inflation a little bit lower. So this wonderful combination of events, I think the equity markets are going with that and saying, look, this is really good.
Yeah, it's a Goldilocks scenario of sorts, really sweet spot. The way that it's kind of been squared away is that this is partially to do with productivity growth. Certainly, that's what Kevin Hassett has been touting. But what is your read on the situation, especially against this backdrop of AI?
And you linked it up perfectly, because we have never had quite so expansive a discussion at a Fed interest rate meeting and press conference as Chairman Powell gave to productivity growth. Now, he has alluded to it before. As an economist, I will tell you, it doesn't get enough credit. I've always felt it doesn't get enough credit. People don't talk about it. It's a difficult thing to measure. And Chairman Powell talked about it a lot. It is the thing that needs to be there to square the circle, if you will, of how do you get higher growth, a very slowly growing, maybe not growing at all, labor force, and get lower inflation rates. It's got to come out somewhere, some way, shape, or form in this issue of productivity. I do think that Chairman Powell made a very valid point by saying it's not just most likely AI. And he cited that he thought that technology improvements and investments and changes in how we do things that occurred over the course of the pandemic years in response to the business challenges of the pandemic years was probably a key factor in this. And that makes sense, because it does take a while for real productivity improvement to work its way into the economy. It's hard to do overnight. And so this would make some sense that it's not just AI.
Jeanette, always great to get your insights. Thank you so much for your time, your analysis. Jeanette Garretty is chief economist at Robertson Stephens. Now, speaking of AI, Oracle shares tumbled in late trade after earnings that suggest its boost in capital outlays may be taking longer to translate into revenue than investors hoped. Let's get more from our tech correspondent, Annabelle Jules. So, Belle, Oracle was a bit of a disappointment, to say the least.
Yeah, well, I think it's really the capex, and this is where investors have been really quite caught off guard, essentially, because, as you said, that problem is the spending they've got on infrastructure isn't really translating into revenue as quickly as perhaps had been anticipated. So let's just go through the capex numbers, because they're actually really significant. In the latest quarter, the company said that it spent $12 billion on capex. Now, that's a huge increase from the fiscal first quarter period, which was $8.5 billion. It's also a lot more than what analysts had been expecting, because they were thinking capex would track down slightly to $8.25 billion. Instead, it came in at that $12 billion mark for the period. Then if you look at the full year targets as well, Oracle says it's going to be spending around $50 billion across the course of the year, or the fiscal year. That's a $15 billion increase from where we were in the last time they spoke about capex, which was during the September earnings. So that's the capex side. On the revenue side, you saw cloud sales. I mean, they increased, and coming in at nearly $8 billion. Revenue from the infrastructure business came in at just over $4 billion, but both of those fell short of what analysts had been expecting. And so investors were already quite cautious, and you can see that drop there in the stock over the last few months. But we have seen about a drop of a third since the stock hit its all-time high back in September. And certainly seems like those fears haven't been allayed at all, because you're seeing Oracle there very much under pressure on those questions really about the exposure that that Oracle has to OpenAI's business in particular.
Yeah, we'll be watching those Asia AI shares as well. And the last time I think that we had such a big sell-off around tech was when DeepSeek came out with its more efficient AI model. And we're now hearing from sources that they're using some of those Blackwell chips from Nvidia that are banned for exports into China.
Yes, so this is reporting from the information, and as you said, what its main thesis is, or what it's reporting here, is that DeepSeek's been developing its next major model, because we haven't actually seen a major model update since the initial one was released early this year, but using thousands of Nvidia Blackwell chips. So that is the most advanced chip architecture currently available on the market, and the information is saying that it spoke with 6 people who are familiar and very close to this matter. So they've reported on quite a complex scheme where chips are essentially being sent to data centers in countries that are allowed to buy them. Then those servers are being dismantled, and then the pieces of the servers containing the chips are being imported, or the equipment's being imported in pieces into China. So this is the web that the information has reported on. Again, it's not our reporting, it is from another source, but if it is accurate, it certainly shows just the difficulties that the US faces in enforcing any sort of export restrictions or controls. And then for DeepSeek as well, it really shows the reliance on US technology, because its models are particularly well suited to using Blackwell chips. Nvidia, for its part, we should note as well, has actually rejected this whole claim of phantom data centers.
Our tech correspondent Annabelle Druller's there. We do have more ahead on the Asia trade. This is Bloomberg. The diplomatic dispute between Japan and China over Taiwan shows no signs of easing. That's despite Komeito, the Japanese party that helped break the ice in a previous dispute, continuing to engage with Beijing behind the scenes. We spoke exclusively to their leader, Tetsuo Saito.
I have stated that Japan's national policy has not changed at all. Their response is that this alone is insufficient. But as for what should be done about it, I'd rather not get into the content further. We've been having various discussions. We've been mentioning our thinking over how to overcome this situation. Honestly, there's nothing I can discuss at this point.
Let's bring in our economy and government reporter Yoshiaki Nohara. Yoshi, where are we in this diplomatic dispute?
As you just watched the TV clip, it's obvious that there's no easy solution at the moment. And when I interviewed Tetsuo Saito, the leader of Komeito, yesterday, it was clear that the communication is going on, which is a good thing. But at the same time, there's no sort of a concrete steps identified toward off-ramp at this point.
Why not, and how might something like that change?
The reason why we are paying attention to what the Komeito is saying is that it was a party that helped break the ice in the previous dispute. But if you know what's going on in the Japanese politics, Komeito is no longer part of the ruling coalition. So that means that it's fair to say, and Saito-san has admitted to me, that its influence is set to decline over this matter. So in other words, Japan is kind of losing the critical pipeline of communication in the ruling coalition in terms of how to renegotiate this, with Beijing and de-escalate the situation. So we're not seeing the effective new channels of communication coming up at this point.
Yoshi, thank you so much. Bloomberg economy and government reporter Yoshiaki Nohara. Now, Mexico's lower house has approved broad import tariff increases across multiple sectors. The targeted countries include China and several other Asian nations, including India and South Korea. Let's bring in Bloomberg Mexico economy and government reporter Gonzalo Soto. So, Gonzalo, what does the new tariff bill include, or does it change anything?
Hi, nice to be here in the show. The tariff basically changes or implements tariffs on 1,463 different products, mainly from China and other Asian nations. And the tariffs will be implemented on a wide range of products, including automaking, auto parts, steel and aluminum, toys, home appliances. And this basically changes the way Mexico conducts its domestic commercial and trade diplomacy, or its trade policy. And it's aligning much more to what the U.S. is doing right now in terms of trade and tariffs.
Yeah, give us that larger context of why this action is significant right now. Because as you mentioned, Mexico might be aligning more closely with the U.S., despite the fact that we have seen China's increasing overtures to Latin America as well.
I mean, after decades of inking various free trade agreements with several countries, Mexico has decided to start protecting its industries. That's the main argument from the government, that they will begin to protect industries that have been affected by growing Asian imports. But basically, what this brings is a sense of alignment with the United States policies. Of course, 2026, in the summer of 2026, not only will Mexico, the United States, and Canada be hosting the World Cup, they will also be revising the USMCA, and therefore the Mexican government is trying to align itself more with its northern neighbor that, of course, represent over 80% of the Mexican exports. Also, the Ministry of Economy will get a new kind of power, which will allow it to implement or to change these tariffs as it sees fit during the year without having to go or undergo the legislative process. This will, of course, come handy during the USMCA negotiations as well.
What are some of the other consequences expected from this bill, and might it affect whether Mexico gets some form of steel tariff relief?
Well, sources have told Bloomberg that although this tariff is important for Mexico, it will also give Mexican negotiators in Washington more arguments to deal with the White House, to deal with the USTR, and to get some sort of reprieve in steel and aluminum, which are tariffs that have been implemented to Mexican products. And several sectors say they are already hurting because of these tariffs. So this could be something that could help alleviate, at least at some point next year, the tariffs implemented by President Trump.
Bloomberg Mexico economy and government reporter Gonzalo Soto, thank you so much for that context. We'll also be watching the upper house vote in the next hour for that potential passing of that tariff bill. More ahead on the Asia trade. This is Bloomberg. We're watching the price of oil after it was supported by the latest move by the U.S. to intercept and seize a sanctioned oil tanker off the coast of Venezuela. Venezuela's government now coming out with a statement saying that the U.S. move on the tanker is an act of piracy. Of course, we have seen President Trump ramping up the pressure when it comes to President Nicolas Maduro's government, accusing him of presiding over a drug trafficking operation. Avril will continue to watch the price of oil in the Asian session after it erased earlier declines after U.S. forces intercepted that oil tanker.
The oil story, I think, going to be interesting to watch as well as we keep an eye on the inflation outlook for next year, given what the Fed has been doing. But to some of our Other top stories: over 500,000 people have been displaced following fresh border tensions between Thailand and Cambodia. At least 12 people have been killed as both sides exchange artillery fire, with Thailand deploying F-16 jets after accusing Cambodia of firing rockets into civilian areas. President Trump took credit for ending the clash back in July and says he plans to speak to leaders of the country soon. U.S. and Indian officials have begun talks aimed at resolving differences and finalizing a trade deal. New Delhi says discussions touched on economic and tech partnership as well as opportunities to boost trade and resilient supply chains. The two sides have been working on an agreement to address Trump's 50% tariff on Indian goods. A federal judge in New York has ordered the release of grand jury materials from the sex trafficking investigation on financier Jeffrey Epstein at the request of the U.S. government. The ruling follows similar decisions by judges in Florida and New York. Last month, President Trump signed an act requiring the Justice Department to disclose all related unclassified documents. Shery?
And this is a setup as we head towards the market opens in Japan and Korea. We'll be watching those tech stocks given Oracle's disappointing capex spending. And of course, the Fed's third consecutive rate cut, and Asian currencies could be at play as the dollar has now weakened alongside Treasury yields. The market opens are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens after the Fed's third consecutive rate cut. Avril, something that analysts are calling a potentially moderately hawkish rate cut from the Fed, but perhaps that bullish sentiment in the overnight session dampened a little bit by Oracle's results with those concerns over AI spending.
It was interesting how we saw the dollar react to the Fed, and given how its declines were the worst since the middle of September, how might that set us up for Asia session, given the reprieve it might provide to currencies as well, Shery?
Yeah, we had already seen the Japanese yen supported in the overnight session, perhaps not really lasting towards the early Asian session. But take a look at how the Japanese stock market is also coming online. Of course, we are talking about those rate cuts from the Fed. At the same time, we have expected BOJ rate hike coming next week. And you can see the Japanese yen holding at just below that 156 level against the U.S. dollar. We have seen the rise in yields here in Japan. The two-year yield, for example, at the highest level since 2007. Prime Minister Takaichi already commenting that she's not really concentrating on rising yields, but more about growth in Japan. So we'll be watching the JGB space very closely as we head towards that BOJ rate decision, as well as I mentioned. But we're also getting South Korea's export numbers for the first 10 days of this month, rising 17.3% year on year. Not surprising, we have seen those chip makers really sending out those exports into the world, and imports rising only about 8% year on year. But the Kospi at the moment rising 0.6%. We've seen a little bit of more instability for the South Korean market, especially when it comes to the currency. So we have seen now Korea's National Pension Service reportedly really buying those dollars in order to support the local currency. We're seeing a little bit more upside of 1464 for the South Korean won, Avril.
To your point about the BOJ earlier, Shery, it's interesting. All these G10 central banks are turning more hawkish. We even heard from the likes of the Bank of Canada, the economy they think is more resilient to tariffs than previously thought. So what is that going to mean for the dollar as we talked about those declines? And as you see, perhaps a Fed that was less hawkish than some had anticipated. You are seeing the short end pick up, particularly on the 2-year. The yields are coming down. S&P 500 futures, to your point about Oracle, maybe that is a dent on sentiment a little. We are also hearing how Fed Chair Powell addressed the dissent at this meeting.
It's a close call. We have to make decisions. And we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once.
Let's bring in our Federal Reserve and Economy reporter, Enda Curran. Also joining us is Kelvin, Regional CIO at UBS Global Wealth Management. Great to have you both. Kelvin, let's start with you first. So when it comes to the initial reaction to the Federal Reserve, is that your assessment that it's less hawkish than anticipated? What is this going to mean for markets?
Yeah, I think he was a little less hawkish than expected. In fact, I would actually say that he was a little bit more on the dovish side, especially his comments on the fact that he thinks that inflation is going to be a one-off and thereafter actually start to tail off. And if you look at the Federal Reserve's economic forecast as well, they've actually raised the forecast next year to 2.5%. And I think the reason for that is because they see productivity coming in to actually lift growth and actually keep the costs actually quite under control. And they do think that inflation is likely to actually come off to about 2.5% to 2.4%, thereabouts, where core PCE is concerned. So I would say that overall it's actually a little bit less hawkish than what we were actually looking for.
And we did see, though, the change in language from the Fed statement that potentially last time it really signaled that pause when it comes to those rate cuts. What's the key takeaway for you here?
Well, I think, look, the cut was... Excuse me, sorry. The cut was expected.
And go ahead.
The cut was expected. The large growth upgrade, I think, was something of a standout in terms of their forecasts. But of course, the other big takeaway was the level of disagreement now among the policymakers. You had 3 dissents on the decision itself today. That's the most since 2019. You clearly have a very divided outlook in the dot plot in terms of where interest rates in the US might be going over the next year and year after that. And of course, then in the finer detail, there's another short-term rate where the regional Fed presidents were showing their displeasure at bringing down that rate also. So when you take it all together, it's clearly a divided policy committee and signaling that next year, when they do move into next year and do move into getting that new Fed chair from May of next year onwards, it's probably going to be very hard to get consensus in terms of where things are standing right now, at least.
Endo, what else stood out to you from this? I mean, apart from policy, there had been some chatter about the Treasury bills purchases. Is that plan coming in as expected?
Maybe a little sooner than expected. Avril kicking off on December 12th. But, you know, both the Fed and Fed watchers make the point that this is all about, you know, liquidity, making sure they have the ample or abundant reserves in the system to meet demand. This is not necessarily, of course, a move to support the economy or necessarily, of course, a move in the direction of QE. But nonetheless, I think the move has come sooner than expected, and it shows that the Fed story has been moving fast. The narrative has been changing fast. It now appears as though we're at a point where, in the policy side of things at least, perhaps they're going to wait and see. Fed Chair Powell said in the press conference they have a lot of data coming out over the coming weeks that will help form their views for January. But he really wasn't giving a firm signal in terms of whether or not a rate cut will come in January or the months after.
Kelvin, what do you make of those Treasury purchases? Given, of course, that we have seen that incredible pressure in the bond space, could this be sort of a backstop as well?
Absolutely. I think what's key to the Federal Reserve is that they want the yields to come off, right? And if you look at the 10-year yields at 4.13%, that's actually a little bit too high and a little bit higher than what they're actually really comfortable about. I think the Treasury yields on a 10-year basis, we have them coming down to about 3.75% next year, largely due to the fact that we are actually forecasting one more rate cut next year and also the potential deregulation of the financial sector via the supplementary leverage ratio. There is vested interest to keep the yields down because of the fact that the U.S. will probably have to refinance close to about $7 trillion over the next 2 years again. And you don't want them to actually to refinance on the short term of the tenor again, like what they had done this year, basically on the 2 or 3 year, because that's basically just rolling the curve down the road, just kicking the can further down the road and reissuing every 2 to 3 years. That's not really what you want the Federal Reserve to do. You want them to be able to refinance on a longer term basis at reasonably more palatable levels.
What is all this going to mean for Asian currencies particularly the rupee, the Korean won, that could use the reprieve. And then when you put that together with the Japanese yen, the BOJ expected to hike next week, but that's not really providing enough support for the local currency.
Yeah, I think the problem with the central banks in Asia is that you get a weakening dollar, which is actually great. And it really depends on the economy itself. Like, for example, in Indonesia, a weakening dollar is great because of the fact that, there's potential for the BI to actually cut rates further without the currency suffering any form of depreciation risk. In India itself, it's a little bit more different, largely because of the fact that the economy actually really do need the cuts. And on top of that, if the Indian consumers continue to actually purchase gold at these prices, that means there's an outflow of Indian rupee out of the economy. And that's why you're getting this weakness where the rupee is concerned as well. So I think the lower US dollar will certainly bring some reprieve to some of these economies there, and actually helps the central banks, most of the central banks in Asia, to ease the rates a little bit further, which is actually great for us. And on top of that, every time you have a weakening dollar in the region, it's actually good for Asian equities, Asian bonds as a result of that, because of the inverse correlation, which is actually really, really high.
Kelvin, do you think this will also give some reprieve to the Bank of Japan and the weakening Japanese yen? Because I've heard really conflicting ideas that perhaps it doesn't matter what the Fed does or the BOJ does, given the structural declines in the Japanese currency, that really those gains in the yen are capped.
I think we need to keep a lookout for the 10-year yields where the JGBs are concerned. I think if they cross 2%, then clearly the path of the Japanese yen is likely to be capped at how much they can actually weaken. You want to keep an eye on the yield gap between the 10-year yields and the 10-year US Treasury yields and the JGBs, largely because of the fact that if the gap closes, then obviously it's going to be a little bit more harder for the lifers and the insurance companies in Japan to actually start to actually continue with their purchases of US Treasuries, which is really what's actually keeping the yen weak. So I think if the gap actually closes, then obviously the yen's weakening will probably be limited. And in our case, we think that the Japanese yen is likely to actually move towards the 150 level by June next year.
And I wonder if we could pick your brains about this. The expectation for next year is a soft dollar, and perhaps we still see those concerns on the long end. Higher yields. What is that going to mean for the US?
Well, there's something of a disconnect between what the market's doing and where Fed policy is, by the way. The Fed have cut 3 times in a row now, 75 basis points, probably not getting much return in terms of where yields are. But next year, the Fed forecasts today were clear that growth is going to be very strong. They really had a material upgrade from their September forecast for GDP growth in the US next year. Pretty strong the year after as well. At the same time, as Kelvin said, they're seeing PCE inflation come down close to target, and they're not seeing any major spike in unemployment. So it's a pretty rosy outlook, and I think that backdrop is why there's a sort of a lot of debate around where the US economy is at right now. Just how loose is the labour market? It's very difficult to tell because we haven't had official data. And when we do start to get the official data, both on the jobs market and inflation, it will take several months to get a clean read. And by the way, Chair Powell in the press conference today made that point. He said they're a little bit cautious about what the data will be signalling in the weeks and months ahead because it's going to take a while to get a clean read. So, right here, right now on paper, the economy is set to have a strong first half of the year. The real question is just how weak or otherwise that labour market is, and will inflation keep trending back down towards the target? And those are the 2 critical questions.
And Chair Powell is leaving his job in a few months. If we see a more dovish Fed chair come in, what are the implications for the rest of the FOMC and where the Federal Reserve takes rates from here?
Well, we know there's a political dimension to this Fed chair process over the last several months. We know that President Trump has said that whoever takes over as Fed chair, he will expect him to bring down interest rates. So it's expected to be that whoever does come in will, at least at the very beginning, have a dovish outlook on things. Now, that's where, as you say, it does start to get complicated. What will the economy be signaling? Where will inflation be? Where will employment be? If inflation is benign and, of course, employment is weakening, then there's obviously a case for lower rates. If that's not the case, it, of course, gets much more complicated. And then, depending on those circumstances, that will dictate where the whole the rest of the Fed voting members go. Will there be a green light if inflation is not the story? Then they can pick and choose as they go. Or will that not be the case? And then you're probably going to be getting a very fractured discussion. And that's, people are saying the hints of what we're getting now are just a taster for what could come when the next Fed chair takes over, and if the policy environment is as complicated as it is today. So maybe a taster of what's coming down the road in 2026.
Also in 2026, Kelvin, we've been talking about AI. Today, maybe taking a bit of a breather because of what Oracle's earnings and CapEx have been telling us. You are still very constructive on AI. How do you position as an investor?
I think we are very constructive over the longer term. We have no doubt that AI is going to bring in tremendous productivity gains, more so than the internet revolution did in 2000 to 2010. But in between, you're going to get all these bouts of volatility, all these bouts of tension between monetization and AI capex spend. And I think that will probably bring a lot more uncertainty into the market on a short-term basis. But on a longer-term basis, we have no doubt that it will actually be a clear productivity gain for the entire industry and obviously for the economy as well. The other thing to consider is that we think that there might be some truth towards the fact that, AI is actually bringing through what we call this jobless economic growth scenario. And you're seeing some of that actually coming into the markets already, some of that reflecting in certain sectors within the industry itself. That will increasingly be another key focus point in the future where, even if the economy is growing at 2.5%, you're wondering whether the unemployment rate will actually drop below closer to the 4% range. And I think that will increasingly become another key focus point for the markets in 2026 as well.
Kelvin Tay of UBS Global Wealth Management, also Enda Curran of Bloomberg. Thank you both for joining us in this roundtable conversation about the Fed and, of course, the markets as well. We have more ahead. This is Bloomberg. Asian AI plays in focus today after Oracle shares tumble in late trade. You can see right there a little bit of a mixed picture, but SoftBank losing more than 6%. Of course, this is a company very much exposed to the global AI play with investments in OpenAI. And even this week, we heard from Kyodo News that SoftBank would make additional investments in chipmaker Rapidus. Now, Oracle reporting earnings suggests is boosting capital outlays, maybe taking longer to translate into revenue than investors hoped. Let's get more from our tech correspondent, Annabelle Drewlers. And Annabelle, we're really looking forward to this Oracle results because they're really the pinnacle of those AI investments, right? And it seems to have made investors quite anxious.
Yeah, I think exactly that's it. I mean, if you think about Oracle as a company, it's heavily involved in Project Stargate. It's in partnership with Project Stargate with SoftBank providing the financing. It's OpenAI, of course, and concerns that we've seen really here for weeks about the fate of OpenAI essentially against competitors like Alphabet's Gemini in the market. And so, I mean, I guess the big thing that investors need to see is more ROI from companies like Oracle, and they didn't really get that in the latest numbers because the concern here is that all of this spending we're seeing on infrastructure isn't actually translating into money being returned as quickly as maybe had been anticipated. And when you think about the latest figures, the big concern was really around CapEx, and the company certainly spent more than what had been projected. So it was $12 billion for the fiscal second quarter. That's a huge increase from just the period prior when it was $8.5 billion. But it's also more than what analysts had been expecting for the period. They were thinking it might actually track down to $8.25 billion. Instead, it's that $12 billion mark. And then at the same time, if they gave updated projections for the fiscal full-year spending, and that came in at $50 billion. And that's a $15 billion increase from what the company last mentioned, which was back in the September period. So they're really continuing to spend a lot more on this infrastructure. But then at the same time, when you take a look at the revenue streams, for instance, from the cloud division, that did increase, but it came in at nearly $8 billion as well. Infrastructure business, that came in at just over $4 billion. That was short of what analysts had been expecting just. And so investors, as I said, they're very cautious about Oracle, given its close ties to OpenAI, its aggressive spending, and those fears certainly haven't been allayed through these latest figures either. And the stock now is down around 30% from its high that it hit back in September of this year.
Bell, another company with close ties to OpenAI is Nvidia, and we're hearing reporting from The Information that DeepSeek might have been using chips from the U.S. tech giant that were banned for export.
Yeah, so this is some reporting that, as we said, from The Information, and they what they're saying is that DeepSeek's been using or developing its next major model using chips, Blackwell chips from Nvidia. So we haven't actually had a major model update from DeepSeek since its first one came out earlier this year. We've had iterations on that first model, but we're still really waiting for R2 to be released. And so what The Information is saying is that the Blackwell chips are being used in that effort. So they've spoken with 6 people who are familiar with the matter, and they explain the structure of how this was actually taking place. So they're saying there was quite a complex scheme where chips were being sent to data centers in countries that could actually purchase those chips. Then they were being dismantled, the servers, and then that contain those chips, and then that equipment was being imported into China. So that is the web that The Information reported on. If it is accurate, I think it certainly shows for a company or for the US government just the difficulty of trying to maintain and enforce those export controls. But for DeepSeek, it also shows that reliance on US technology because its models are built using a technology or a method called sparse attention. And Blackwell chips are particularly well suited to this approach because they include specialized hardware that's designed to accelerate sparse computing. Now, that's the story for Nvidia, or for DeepSeek rather, but for Nvidia, they've actually come out with a statement, not referencing The Information reporting specifically, but they are just saying phantom data centers in general. And in their statement, they said they haven't seen any sort of tips of phantom data centers constructed to deceive us, designed to deceive their partners. And they are saying that smuggling could seem far-fetched, but they do pursue any tips they receive. So it's quite a firm rejection from Nvidia on this story. But again, The Information is reporting it and saying they spoke to 6 people who are close to the matter.
Belle, thank you so much. Our tech correspondent, Annabelle Drewlers. And here are some other corporate stories we're tracking. Intel, AMD, and Texas Instruments are facing lawsuits accusing them of failing to keep their chips out of Russian weapons used against civilians in Ukraine. The suits allege the firm showed willful ignorance as third parties resold restricted semiconductors to Russia, powering drones and missiles in violation of U.S. sanctions. They also claim components were diverted to Russia and Iran. Microsoft has revealed more details about its big bet on India's AI ecosystem. The tech giant earlier pledged to invest more than $17 billion in AI and cloud computing in the South Asian country over 4 years. During a speech in New Delhi, CEO Satya Nadella said they will also double their skilling initiative.
We are committing to skill 20 million people across India in AI skills, and so we are very excited about this.
President Trump has signaled he will oppose a Warner Brothers deal that doesn't include new ownership of CNN, creating a potential wrinkle for the bid from Netflix. The streaming giant's plan includes a spin-off of Warner's cable channels. Paramount, for its part, is trying to buy the company outright for $30 a share.
I think any deal should be guaranteed and certain that CNN is part of it, or sold separately. But I don't think the people that are running that company right now and running CNN, which is a very dishonest group of people, I don't think that should be allowed to continue.
More ahead on the Asia trade. This is Bloomberg. We're watching oil-related shares in Asia alongside crude prices after U.S. forces intercepted and seized a sanctioned oil tanker off the coast of Venezuela. Let's get to senior editor John Harney in Washington. John, what do we know?
That what we know is that U.S. forces, we don't know if they were Coast Guard or Special Forces, with Black Hawk helicopters in a very dramatic fashion, boarded this tanker, which was already sanctioned by the United States, and seized it. Now, what this does is raise the stakes substantially in President Donald Trump's campaign to oust President Nicolas Maduro of Venezuela. And it does this by threatening Venezuela's oil industry, which is crucial to the Venezuelan economy, that's because it makes it much harder for Venezuela to now sell oil to its clients, including China.
What's the ultimate goal here for President Trump? Just quickly.
We don't really know that yet. I mean, he obviously wants Maduro out, but he has not said how he's going to go about it. Now, there's been a huge military buildup in the Caribbean in recent weeks and months. Will there be an attack on Venezuela? We do not yet know. This all happened as Maria Corina Machado, by the way, was awarded the Nobel Peace Prize.
Right. John Harney, our Bloomberg senior editor, following the latest on that Venezuelan oil tanker, as we have now heard the reaction from Venezuela that the U.S. move on the tanker is an act of piracy. This is Bloomberg.
And we have some breaking data crossing the terminal out of Australia in terms of the jobs market there. The jobless rate, unemployment rate coming in a bit lower than the consensus. So 4.3%. And this is in line with what we got the prior reading, but a bit of an improvement compared to what economists had been expecting. In terms of the employment change, now this one might be a bit of an brow raiser. If you look at the number of jobs there, it has fallen more than 21,000. And I think the survey was expectations of an increase of 20,000. So what does this tell us about the labor market in Australia? Maybe things are getting a bit looser there. For the moment, we are also looking at Asia FX as well, Shery.
Yeah, after we saw that little bit of a hawkish turn coming from the RBA governor, right? And we saw the Aussie actually gaining ground. So perhaps a little bit of consolidation there. But take a look at how other currencies are trading, because we saw the dollar falling in the overnight session along with Treasury yields. And we're seeing a little bit more upside, both on the Japanese yen, Korean won as well. And the Korean won has been pressured a lot recently. So we're even hearing reports that the National Pension Service is said to be selling dollars in order to support the currency. The offshore yuan holding steady at that 7 level, Avril.
And as you speak about the Japanese currency, the yield differential between the U.S. and Japan is certainly back in focus after the Fed cut. And this chart shows you how it's capping the move on the yen, although it is gaining ground in the Asia session. Let's bring in Asia FX and Rates Chief Correspondent Ruth Carson. So, Ruth, where does the yen go from here?
That's the trillion-dollar question that is on everyone's minds every day, considering the yen is the third most traded currency in the world. So rate differentials definitely matter. And we saw the Fed decision overnight. It was a cut as expected, but the fact that yields didn't fall too much in the US definitely is something that macro traders will be looking at, and its impact on Japan and obviously the yen. The BOJ will be critical next week for sure. So depending on what the BOJ signals, dollar yen is trading around 155 to 157 on any given day. If there is a hawkish tone adopted by Ueda going forward, definitely we could see the yen getting more of a bid against the dollar.
Ruth, where's that dollar headed? Because we have seen sort of conflicting perceptions coming from the dot plot and what the Fed actually is thinking about the rate trajectory next year to what traders are seeing in terms of rate cuts.
Absolutely. And if we look at the WIRP function on the terminal, it gives you a sense as to what traders are thinking. And in the last 24 hours, we have seen a pairing of expectations on the Fed's rate cutting path for 2026. So what does that mean? In theory, a weaker dollar. And we did see the dollar fall in the previous session, and it is a little bit weaker today. Now, whether or not that holds remains to be seen. Definitely, the risk on currencies like the Aussie is definitely up in general today. I know we've got the data that's just come through, but to really read what is in store for the dollar in 2026, we'll definitely have to pass not just the Fed's policy and their comments, but what other central banks are saying too.
It's interesting, right, Ruth, because it looks like the Fed is disconnected with other G10 central banks. And some might say that's a similar situation in terms of the way yields are faring compared to the Fed having cut. Where do we go from here then?
Yeah, it's a very unusual time in markets. And PGIM had a wonderful way of encapsulating what's happening right now. It's called the disappointment trade, so to speak. Bond investors are passing what policymakers are saying, what central banks are signaling, like the RBA, for example, and the hawkish turn earlier this week, and going, you know what? Rate cutting cycles really are ending or appear to be ending, and as such, you know, you may cut today, you may cut next week, but yields, we always move ahead, and so that's why you're seeing the pressure upward on yields.
Asia FX and Rates Chief Correspondent Ruth Carson there with the latest on that space, as we're also watching, of course, the equity space across Asia with the Nikkei and the topics now reversing some of those earlier gains. We have, of course, a little bit more strength on the Japanese yen. Let's bring in Bloomberg's Alice French. Alice, I mean, we had seen the optimism coming from the Fed rate cut, but then we had the Oracle AI spending concerns. What's the outlook right now for the equity space?
Yeah, it's tricky, right? Like you say, I think there was a lot of optimism kind of early in the morning. We were seeing banks gaining, I think, kind of hopes that, you know, that the economy is picking up in the US and that helped. But of course, SoftBank, we know, has a very big weight on the benchmark. SoftBank is down today because of those Oracle earnings. And I think that that's really just kind of, it's kind of just thrown everything for a loop. And we're now seeing the Nikkei down, the topics down. I mean, we know the AI sentiment feeds through to pretty much every corner of the market. And so I think we may have another kind of flip-floppy day here in Tokyo, I think, for equities.
Especially since we also are watching geopolitical concerns with the ongoing Japan-China spat. We heard from the leader of Japanese party Komeito. Take a listen.
I have stated that Japan's national policy has not changed at all. Their response is that this alone is insufficient. But as for what should be done about it, I'd rather not get into the content further. We've been having various discussions. We've been mentioning our thinking over how to overcome this situation. Honestly, there's nothing I can discuss at this point.
How much of an impact does this spat have on Japanese markets?
I mean, look, it's been going on for kind of a month now, and I think that's actually longer than some investors had kind of expected. Particularly, you know, we're already seeing that flights are being cut between China and Japan. Of course, that's a worry for the tourism industry, and we know that, you know, we've seen record numbers of tourists coming into Japan this year. That had been a really big tailwind for retailers, right? So department stores, things like Muji, things like Uniqlo, they've been really benefiting from that tourist spending, and we know that Chinese tourists make up almost a third of total tourist spending in Japan. So there is a risk there. Those retailers, they have been underperforming the benchmark since those Takaichi Taiwan comments in November. And I think that there are some jitters and some worries that could kind of continue into 2026, especially if we see any kind of escalations. Of course, we know there are obviously other tourists. We have tourists from the US and Europe, especially from the weak yen. To an extent, they may be able to cushion that blow, but definitely I think it's a risk, you know, especially for companies as well that make money in China.
Exactly. It's not just about Chinese tourists or tourism, right? It's also what happens if the Chinese economy is actually continuing to slump into next year, and all of these interconnected economies. What's the outlook for 2026 then?
100%. And I think, you know, especially for Japanese companies that do really rely on that Chinese revenue, we've got Shiseido, for example, it's a really high-risk stock. But of course, you know, whilst the China risk could be, I suppose, a Japan-specific downside, there's also a lot of upsides to look for in Japan in 2026. You know, as Ruth was saying earlier, we're expecting a BOJ rate hike this month. That's going to be another tailwind for banks. We've still got a lot of corporate governance reforms going on. We've got, you know, this M&A boom that's ongoing. I think there's still a lot of reasons to be cautiously optimistic optimistic going into next year. Of course, the AI dynamic is still going to play out, and SoftBank and Advantes will still have, big impacts. But I think the China risk, yes, it's still there, but there are still lots of reasons to be optimistic and to have those hopes.
Bloomberg Japan stocks reporter Alice French, of course, and that optimism has been really felt across banking shares here in Japan as well, given rising yields, as we're expecting that BOJ rate hike to come next week. In fact, we talked to Japan's third largest lender, Mizuho Financial Group, its CEO Masahiro Kihara, saying that they're building out their investment banking business to full scale. We asked him if he thinks Mizuho's U.S. business will be impacted by the Fed's rate cut as well.
It will have a positive effect on our business. The momentum will continue probably, and that's good for us. Yeah.
When it comes to the economic outlook for the U.S., do you expect the Fed to do more, given what you talk about those challenges?
Well, I think that's what we expect. I'm not maybe 2 or 3. Yeah.
In 2026.
Yeah.
You are already seeing the slowdown in the U.S. economy.
Well, if I talk with my people, what's happening in the real world, it looks like a little bit of slowdown is happening. Yeah. Although it's not still on the figures yet, but I think that's the reality. Yeah.
But when it comes to those rate cuts, as you mentioned, it's still very positive for your business.
Oh, of course, it's very positive for us.
Where is growth for you in America?
So we have been building out our investment banking business to a full scale. 2 years ago, we bought M&A boutique from Green Hill. We finished the integration. And that by using our Mizuho platform and Green Hill platform, we're now able to pursue large-scale M&A deals, get the full value chain starting from M&A. For example, recently we did a big deal for Skechers, where Skechers was acquired by 3G Capital. In the old days, we never thought about that. Right now, we can do that kind of deals. Also, cross-border deals. Japan, U.S., that's expanding in our platform too. So U.S. is becoming a catalyst for our growth, actually.
Are you seeing a lot of competition from other domestic rivals?
Not really in this U.S. investment banking, I think. I think our strategy is to get all the capabilities that we want inside our bank, actually. Mitsubishi, SMBC is a little bit different, the strategy is. So not seeing a lot, bro. And rather seeing more competitions from European peers, or we're not going to be the 5 peers like the U.S. banks, but rather competition is from the European banks probably. And from a global perspective, our CIB league table, we were 13th last year. Right. This year we ratchet up to 11th. Actually.
Yeah, you continue advancing in that market. And you mentioned the U.S.-Japan cross-border deals as well. There's a lot of activity here.
Yes, there is.
Give us some of your outlook for 2026.
So I guess, I think everything starting from the corporate governance reform that has been executed by the Tokyo Stock Exchange, and that is still continuing, I think. And people, and the mindset of the CEOs has changed, that they need to improve their returns, ROEs, they need to invest. And we have been very, very strong in the large cap sector. And we have been able to capture corporate actions based on such momentum change. Also, what's interesting is that momentum change is spreading out into the mid caps too. Let's say 50 billion to 100 billion market cap. And we added on CIB capability in the mid cap sector. And what happened is that in 3 years, the revenue, the CAGR was somewhere around 60%. So I think the economy is trying to revive. The corporates are starting to make sure that they want to, starting to improve their return. And then we have a new prime minister who is eager to, grow the economy. So I think overall, Japan will be very, very interesting.
President and Group CEO at Mizuho Financial Group, Masahiro Kihara, who also expects the yen to trade around 145 to 150 per dollar as rate differentials start to narrow. We have more ahead on the Asia trade. This is Bloomberg. Mexico's lower house has approved broad import tariff increases across several sectors targeting Asian countries, including China, India, and South Korea. Let's go to Mexico City and bring in our bureau chief, Carolina Millan. Carolina, give us the broader context of this, because it's not just about one bill, right? It's a broader significance of realignment of Mexico towards the United States and perhaps away from the likes of China that has been making inroads in Latin America?
Absolutely. There's a lot of anticipation over this bill, which should be voted on in the next half an hour to an hour here in Mexico City this evening. And the idea behind it, of course, the government has spoken about the importance of protecting its domestic industries in the context of the changing trends of the world. It's also interesting that this is all happening just months before 2026. Which is when a review of the USMCA trade agreement that Mexico has with the US and Canada is also coming due. So there's certainly a lot of factors at play.
Where are we on US tariffs on Mexico, and how might this bill going through actually affect any of that?
That's a great question. So we know that Mexico authorities have been discussing with the U.S. over the last few weeks, given that even though they're mostly exempted from the tariffs that the U.S. has put on most products, thanks to the USMCA, certain products such as steel and autos and auto parts have been greatly affected. And so there is a sense that passing this bill through Congress will give Mexican policymakers additional arguments that could potentially support them in getting some relief over some of the tariffs. Remember that some of the tariffs that are going to be put in place through this bill are targeting particular industries. For example, Chinese cars. Those will be receiving a tariff of as much as 50%. So it's a significant move to protect some of these industries and to prevent from these Asian products, especially from coming through the country.
But Carolina, there are some sectors also that rely on Chinese imports, right? So I thought there would be some more opposition from the private sector and even within the ruling party as well.
That's a great point, and we have seen opposition within the country. I mean, this bill was proposed by the government back in September. It has been delayed thanks to the lobbying done by foreign companies, by local companies, and by governments. But ultimately, the sense that this bill will support both the local industry while also supporting Mexico in its upcoming trade talks with its partners has seemed to prevail in this particular case.
Carolina, thank you so much. Our Mexico Bureau Chief, Carolina Millan. Now, talking trade, Southeast Asia has also been emerging as a beneficiary from the global trade turmoil, with the region's exports to the U.S. growing at a faster pace than China's. Bloomberg's managing editor, Jill Deeses, joins us now for more. So, Jill, this is something of a phenomenon we saw during the first trade war in Southeast Asian nations benefiting. What are we seeing this time around?
Yes, that's right, Avril. I think when you're looking at this Lowy Institute's study, there's a couple of numbers that I'll just point out to you here. So what they studied was actually exports in the month of September. If you're looking at the Association of Southeastern Nations exports, so that's 11 countries, led by Thailand and Vietnam, exports to the U.S. actually increased 23% in September from a year earlier. That's compared to, by contrast, China's share actually declining. What's I think really important to remember here is that when you take into consideration all of the tariffs that the Trump administration has really put forth this year, the effective tariff rate on China, it's jumped to 31%, whereas if you're looking at a lot of countries in ASEAN, that effective tariff rate is only around 11%. So what the Lowy Institute is ultimately saying here is that taking into account those effective tariff rates, taking into account the way that the tariffs have unfolded over the course of this year, you actually see a lot of markets in Southeast Asia remain competitive, despite earlier fears that a lot of the chaos around this tariff regime would ultimately result in more damaging impacts on their economies.
Yeah, especially given that we saw the Trump administration also target some of those imports coming from Southeast Asia that were coming from actually China, right? So when we're seeing this chaos in the tariff space right now, what are the chances that Southeast Asia can actually grasp this as an opportunity to increase its own volume of trade?
That's right. Well, I think that there's a couple of things, first of all, to kind of take into consideration here. Obviously, supply chains are incredibly complex. Bloomberg, we've talked to, many manufacturers over the course of this year, who have had to try to figure out how to hedge, exactly what their supply chains look like, particularly because of concerns about Southeast Asia and China. In some of those instances, obviously, it's very difficult to just move something from, one economy to another economy because you're trying to deal with this tariff regime. Obviously, I think, when you're looking at this Lowy Institute study, there's opportunities for some to benefit. But I do think that the overarching issue remains a lot of this continues to be uncertain. We have seen in some cases some of these trade deals, be renegotiated over the course of several months, maybe, looking at something going into next year. And there's, quite a lot that does remain unpredictable about how exactly this tariff regime is going to continue going forward. Obviously, again, many of these deals seem to be kind of figured out. But, we also do know that the Trump administration has a penchant for, particularly when it comes to an economy like China, kind of doing, sort of renewing trade truces and deals and such on a rolling basis. Even many of the agreements that were reached between Donald Trump and Xi Jinping at the, the APEC summit in Korea, we're really only looking at maybe a time frame about a year out. So it could be that things, ultimately change going into the future.
Despite this trade truce, still some lingering uncertainty about policy. Jill, thank you so much. Our Bloomberg Managing Editor, Jill Deesis. Now, all eyes have been on the Fed in the post-FOMC. Take a look at how metals have been faring on perhaps what's seen as a slightly dovish or less hawkish Federal Reserve. We are seeing gold holding on to gains after the Fed delivered their rate cut. And we are also seeing silver extending the gains from a day ago when it popped above the $60 an ounce level, which was already a record. For the moment, in terms of the red metal, copper is also resuming that march. So you can see how metals in general have been looking really buoyant. For some of them, it's also about the tight supply outlook that is weaving this interplay of supply and demand into commodities markets. We have more ahead on the Asia trade. This is Bloomberg.
Some more rate cuts in the back part of next year, because what you'll likely see is the first part, you might elevate, inflation should still be a little bit elevated. You're going to see that cyclical pickup. In the back part of next year, you might start to see the economy cool down a little bit, and then inflation's likely to slow back down.
Certainly there was scope to get greater dissents from a hawkish direction than what we got. I think 4 regional Fed presidents, potentially Governor Barr, was also leaning against this cut.
The one thing he had left to say was policies at neutral. And he got very close to saying that. He said we're within the plausible range of estimates of neutral, but then when he gave his own opinion, he said we're probably at the higher end of that range. So I think he's still left the door open for January.
If productivity growth is driving gains in overall economic growth, it means we can actually have higher break-evens on the Fed funds rate because the economy can grow more rapidly without having to lower rates.
A slightly less hawkish Federal Reserve seems to be the takeaway of markets today. And could that also put further relief for Asia currencies, including the Taiwan dollar? What is that going to mean for a TAIEX that is already hovering near those record highs? Certainly, we're seeing TAIEX futures pointing to an extension of gains. Hang Seng this week has been experiencing a fair bit of pressure. Again, maybe a bit of a release valve from the Federal Reserve. Shery?
Yeah, and perhaps some relief for the Japanese yen as well, right? Although we are seeing the Nikkei really contending with losses because of communication services and materials, not to mention SoftBank that is losing more than 5%. Remember, very much exposed to AI, especially with the jitters around Oracle posting lower than expected quarterly revenue and caution over AI spending. Do watch out for the miners in the ASX 200 because silver has also touched another record high. That's it from the Asia trade. The China show is next. This is Bloomberg.